Hi everyone, it's Sean from SDK Markets today. We've got an opportunity that we've been following for quite some time in the coal space. As you know, we were very big on critical minerals for the last couple of years. We followed tungsten, antimony. We've had some great success with EQR and Southern Cross. One of our partners doing EQR is Pack Partners, and they've been kind enough to introduce us to a company called Jameson Coal. Today I've got Michael Gray, who's the exec chair of Jameson Coal with us. This company, the coal industry of recent has had a lot of lack of investment, and we see the commodity potentially being strong over the coming years because there's been that lack of investment. And as always, when we're looking at investing, we want that low point of the cost curve in a tier one jurisdiction. What we see with Jameson, it has those things for us where we're looking for our initial investment. They've got through a lot of heavy lifting. They've done the BFS, they've done the feasibility studies, they've proven the coal's there. You can actually see it in one of the photos we'll see very soon. But we think this is an investable asset which is just waiting for its environmental approvals, which we'll go through, and then it'll be going to revenue in the coming years. But it's reached that inflection point where we could see some good growth in the share price. And we think it's the perfect time to invest now, like we have before EQR rallied, before Southern Cross pushed up. This is the time to start investing. So I'd like to introduce Michael Gray for the first time. Thanks, Michael, for joining us.
Thanks, Sean. Great to be online.
Michael, you've had a really impressive background of delivering for shareholders in the past, which we find very important. We like people that have proven execution capabilities like Mike Hudson, Craig Bradshaw. They're guys that we can certainly back, and you've got a very good following where you've got some very good shareholders who have followed you into this investment. You've been working on it for quite a few years, and we can see the coal in the background. I mean, that's the deposit. So, welcome.
Thanks very much, Sean. Yeah, I've been in the coal industry for 30 years, and I guess I'm a real true believer in steelmaking coal. I think of all the commodities, the gap between supply and demand is strongest in steelmaking coal. Steel continues to grow, and what you've seen particularly in Australia, Canada, and the US is a lack of new projects coming into the market.
I think that certainly provides an opportunity, and you've done years and years worth of work working with the First Nations or the Indigenous owners of the land or the previous owners of the land. You've done your drilling, you've done your all the big things, the PFS, the BFS. We know it's all there. We know it's going to work. We know that a low point of the cost curve, which is one of the most important things when we're looking at investing, that will it make money if it's mined and can we beat the other players? You've proven it all previously.
Yeah, look, we've had some great success in other projects I've been involved in. I've done a lot of approvals, probably more approvals in coal in Australia than just about anyone else. Unfortunately, it's got too hard in Australia, and over the last 5 years, I've been working with Jameson in Canada. I had identified the project a number of years ago, and the real attractive features of it, it's in the right location. It's in an existing coal basin where they've been mining coal for 100 years in southern British Columbia, right up in the Rockies. They've been mining there for 100 years. Glencore recently bought those mines for $9.3 billion. Glencore understands the attractiveness of that product and also the cost advantages of Canadian mining compared to Australia. We have a small project in the middle of Glencore's 4 operating mines, and it is an extremely premium product, one of the highest value prime low vol hard coking coals in the world. And we think with the low strip ratio, small footprint, and the ability to develop it, we can develop it in an extremely cost competitive viewpoint. As you mentioned, the company's had the project for about a bit over 10 years. And during that time has just gone through a methodical approach about doing drilling, concept studies, doing coal quality testing, concept study, pre-feasibility study, then bankable feasibility study. And all of those studies have really led to a really high value asset. And the real advantages of it is the right product. It's a low vol prime hard coking coal, which is the most sought after. It's the benchmark. The adjacent mine, which Glencore owns, is called Elkview. That Elkview product is effectively a benchmark product in the world, and which other products are referenced off. So we would be getting 100% of that benchmark price. The other real advantage is it is a low strip ratio. It's only a small project, only has a 14-year life, but the reason for that is because it is so shallow and it's eroded on all 4 sides. And you can see the photo behind me is that's an inspection with some of the First Nations groups. You can actually stand in the coal because the coal is so shallow and it subcrops right around the whole deposit. And so that coal extent about a 4 to 5 meter seam, and that runs for about 500 meters either side of that photo that you can see. So of all the coal projects, of all the steelmaking coal projects anywhere in the world, this is certainly the most advanced from a regulatory viewpoint, and from a quality and cost advantage, it really does provide a real point of differentiation compared to anything else in Australia or the US or elsewhere.
When you're talking a small project, you're talking 14, what was it, 20 million tons?
28 million tons of product over 14 years. So it's about 2 million tons per annum, which is small in, big coal terms, like the big majors and BHP doing 40 million tons and others. But in terms of smaller projects, I mean, that mines are getting deeper, mines are getting harder. And so, the days of the big mega projects is over. It's the small, more boutique size operations which are really going to be the driving force to supply the incremental capacity for the new supply. And so this one, with its low strip ratio and extreme high coal quality, provides a real operational advantage.
You're sort of sitting there after having spent all this money, getting to the point you're at about a 50 million market cap. What's the potential revenues you can get from this project, and what's the money required to get this thing to revenue?
We look at about another $5 million over the next 12 months through that environmental certificate process. And then beyond that, total capex based on our bankable feasibility study is at about 300 million US. We have some paths and some significant interest from customers. Nippon Steel invested $1.8 billion in the Glencore transaction. We are in discussion with Nippon Steel as well as other key customers. Those customers are really concerned about the availability of new supply. And so we really think there are some great paths to funding for development post approval. Our focus has been on just continuing to progress the requirements of the federal and provincial approval process. Over the last 3 years, we have been undertaking a lot of field work and a lot of studies. We've now got that heavy work behind us, and we are really in the home straight of the approval process. The BC government has issuing us a notice to submit the final EIS, and so over the next 4 to 5 months, we will be progressing finalisation of that to submit sometime in the third quarter of the year, and then that gives us then the process to complete and undertake the conditioning and environmental certificate. But effectively, through that engagement, through that all the work we've done with Indigenous nations and with regulators over the last 3 years, we've answered all the questions they've raised. Which is why the province is now giving us the green light to proceed to the final EIS submission. So we are in the home straight of that approval after a lot of hard work.
And so you've done a lot of these in the past, so you don't foresee anything coming unstuck at the end. There was a mine approved a year and a half ago within the province, so they're still open for business. They're still
open for business, and importantly, I think they're probably more open for business now than they were 2 years ago. And there's a couple of factors in that. I mean, the Trump effect has created a real focus on economic independence in Canada. All this steelmaking coal is exported to North Asia. I mentioned Nippon Steel and Potco as shareholders in the Elk Valley Glencore project. All of that coal goes from Vancouver to Japan, Korea, Taiwan, and increasingly to India. There is a real market for that. None of that goes to the US, and so it avoids all the tariff issues and others. And so both the federal government and the provincial government are really extremely supportive of pushing forward on development. In terms of environmental risks, there has been mining in this valley for 100 years, and there are some legacy issues. I guess we get the benefit of learning from those legacy issues and developing a project which can avoid those problems from the outset. But this is only a small project because it's a shallow coal. It generates less waste, which means it has a smaller footprint. And we have none of the kind of poster child rare and threatened species of caribou or mountain goats and mountain sheep that happen in other projects elsewhere in Canada that have delayed projects. This is relatively low elevation by Canadian standards, and so we have no high elevation grasslands or none of the rare and threatened species of concern. And importantly, we've got a really strong relationship with the First Nations groups. We've built that, and that's, I guess, the experience of working in projects in Australia. We've done similar partnership arrangements. Those First Nations groups are not anti-mining. They're anti some of the legacy issues that have happened to mining there in the past. And so what we're wanting to do is to actively involve them in the planning of the reclamation or rehabilitation of that land and what are the future uses of that land. And that's been really well received. And so we have a unique partnership with a couple of the key First Nations groups and looking to continue to progress that over the next 12 months.
It seems like you've got it all together. The revenues this can generate, if you're generating 2 million tons a year, I mean, the BFS, you're looking at $100 a ton with the current price of around 225. It's hundreds of millions of dollars profit, potentially for a 50 million market cap. We know with EQR and with other companies, prepayments for offtakes, if there's not enough product in the market, a lot of these big players will pay you in advance and help you develop the facility. So not all of that money has to come from equity that you need to build the facility at all. I think we're discussing around 20, 30 million will need to come
That's
after
that's
you've got all the
that's yeah,
approvals.
that's our view, and I think you're right that certainly with environmental approval and with certainty of time frame, then customers are really interested in prepayment or minor equity, and looking to use that funding to fund that capital development of the project. I think it becomes a pretty small check from a Jameson size to actually get into production.
I know we've spoke with Lawrence Gersh in several meetings going over this product, and it's very clear to us that they've stopped any new greenfields projects in New South Wales. Queensland was the biggest basin in the world. This is the second biggest basin in the world. They've still got the green light here, but in Queensland, they've stopped really any new greenfield projects as well. So there's not many projects coming online that are there for the taking in the future. This is one of the few, even though it's not huge, but it will want to be snapped up so they can secure that supply in the future.
No, that's exactly right. And I mean, Queensland used to produce about 200 million tonnes of steelmaking coal. It's down to about 160 million tonnes now. And the challenge is that mines are getting deeper and projects are running out of reserve. And so cost of production's been increasing. Strip ratios, BHP strip ratios are sort of up into the 20s now. We have an initial strip ratio of less than 4 to 1 for this project, which is a real cost advantage. But it's that lack of new tons to replace some of those projects that are falling in production, which we really see that opportunity. There's going to be a significant gap, an increasing gap in supply versus demand in steelmaking coal. Steel is still the big winner in decarbonisation because for every decarbonisation strategy in terms of electric vehicles, solar, wind farm, that creates increased demand for steel. For every ton of steel, you need 700 kilograms of steelmaking coal, and is where the source of that steelmaking coal is coming from. This is a premium product, so it actually requires less steelmaking coal per ton of steel, and so there's significant demand for this product, and increasing supply and decreasing supply, and that's really where that opportunity is.
I think where you're looking at your share price, it's sort of been pretty stagnant. It's not that active at the moment. This is exactly what we saw with EQR. You sort of hover around where you've been, and as we get these approvals, that's where this really share price appreciation come through, and that's why the deal's been brought to our investors now because this is the moment to start taking a position on the back of this, and then you've got the big investors coming through after these approvals, where your share price really can skyrocket from there, looking at 2 to 3 times potentially to get a return on your investment in the next 12 months.
Yeah, look, I'd agree, Sean. And it's not just the environmental certificate. There are a couple of other good milestones we're looking to progress over the next 6 months as well. As I mentioned, we're in discussion with steel mills about MOUs for offtake. We're in discussion with the First Nations about some partnership agreements. I think we are in the home straight of the approval process, and as part of that process, there are some other milestones we're looking to progress over that period. And I think, that will lead to increasing recognition of de-risking the project and really giving us the path forward for development.
Okay, this is quite exciting. So we've got the low cost producer potentially. You've got management. I mean, with MacArthur Coal, can you just go over our investors, where you took that company from and where it went to in terms of an exit? So people know you've done this before. You've permitted loads of mines, so you know how to deal with the regulator and First National people. Where did that particular investment go to for investors?
Yeah, thanks, Sean. As I mentioned, I was been in coal for 30 years, and a lot of that was at MacArthur Coal. So I joined MacArthur Coal in 2002, just as the company listed. So it was started by Ken Talbot. It was one of the first few new greenfield coal projects in Queensland. In Copperbella Mine in 1999. I actually met Ken and did a lot of work on the native title for him there, which is I first established my work in experience in approvals and native title. I took over all the projects and exploration at MacArthur, so from 2002 through to 2010, and we built 2 new projects, the Morvale project and the Middlemount project. So MacArthur went from an IPO of 170 million raise to a trade sale to Peabody for $5.4 billion in that 10-year period. It was almost 10 years to the day from the listing when Peabody completed it. And that was really about the relationship with First Nations and the relationship with customers, which was made Macarthur such a significant success. And it's the same approach I'm looking to develop here. Small companies need to develop these projects in partnership, and so we're working closely with the First Nations and in particular the customers to underwrite the supply and underwrite the development, and which is the approach we used at Macarthur, and that was so successful in getting through to the Peabody. In the last 2 years, 3 years, there's been about $20 billion worth of M&A transactions in steelmaking coal. And the real opportunities there are that none of the majors are able to develop new projects. So the only way they've got any growth is through acquisition. So Glencore bought these projects from Teck, Anglo's divested, Peabody's been looking to buy the Anglo assets and others. And so it's all been through M&A. There's been no organic growth. And so opportunities for organic growth are rare. That's why this project is so attractive in that we see some real upside opportunities in terms of value. Looking at the metrics of those projects and those transactions, this project has substantial value as we progress through approvals and through to the development.
And everything's been proven. So at the final stages of that. Thanks, Michael. I'm just going to have a chat with Lawrence Gersh, the Senior Research Analyst at PAC Partners, who is lead manager on this offer. Lawrence, can you just give us an overview of the macro thematics for coking coal in the current market environment where you see it going over the next several years?
Indeed. Yes. I've been doing commodity analysis for over 40 years, and it's always about looking over the horizon. The current market's firm for hard coking coal, but I believe it can get a lot firmer. And really, it's all about the chronic underinvestment and in very mature assets that dominate the hard coking coal scene, that's seeing the potential for cost rises. We're seeing that now, but it'll get more into the future, and long development timeframes to make up the shortfalls of supply when the world is going to require a hell of a lot more steel, particularly in emerging nations like India, which has got a population bigger than China, but a fraction of the steel intensity of use there. And also for the traditional users like Japan, Korea, Taiwan, they're looking for security of supply, which we know that's an important issue for all producers of things like steel and other materials. So what we're finding is the traditional sources of this fantastic resource, the high quality coking coal, like in Queensland, are facing much higher royalties and of course much higher strip ratios. So instead of the 12s to 15s, it's now 15s to 20 to 1 strip ratios. So it behoves investors and for myself to look for ways in which investors can participate in newer mines which have got better jurisdictions, cheaper taxes, in other words, but also literally lower structural costs. And on top of that, I'm using demand projections for steel that don't incorporate the latest development, which is really data center revolution. And what does a data center use? Well, you have to build a data center, but more importantly, it needs to be powered. So there's a lot more solar, wind power to go in, and the transmission lines, that's all steel intensive, but they're also gigantic water users. And there's going to be need for pipelines to be brought in all those regions. And that is not factored into the future of steel demand. And I think that shock will be the one to come over the next 12, 18 months. And coking coal, we need coking coal to make the mass amount of steel that the world needs. So I see lack of investment, and we're seeing that with BHP effectively not putting in any more capex into its Queensland coking coal. So we're looking for other places where we can find those new sources of supply, and Jameson Resources ticked all the boxes for me. Again, I look over the horizon. A few years ago, I did the same thing with tungsten, and I got in there, rolled up the sleeves and backed EQ Resources. I see different circumstances with coking coal, but the similar dynamic of higher prices and the need for users to diversify supply. Security of supply is the real issue, and this is going to be a premium in the market, I believe, over the next little while.
Well, I agree, Lawrence. And you look at that pricing at the moment of around $220 a ton. We're sort of at the low point of it. It has gone as high as 600. So if it does get down to 200, 150, 100, where worst case scenario, we're still making money. As you're saying, that low strip ratio, that low point of the cost curve is
Yes.
extremely important with this commodity. But it also means when the price rallies quite highly, which could potentially go up to 600 like it did back in 2022, this company's got the ability to make hay when the sun shines and ride out the tough periods. So it's a very interesting position to be in.
Yeah, no, it's a good story. There's a medium term story, but the longer term story when we're in production, I do think that this is valuable equipment. The market will either re-rate this company or it will be taken over. In either case, I think the shareholders will benefit.
Thanks, Lawrence. Thanks for your time.
Indeed. Bye-bye. Thank you for the opportunity.
Michael, I really do appreciate your time. You've covered a lot there. The transaction is going live this week. The term sheet and all the information is attached to this email. If you've got any questions, please reach out. But it's a very exciting project in a tier 1 jurisdiction, low point in the cost curve, management that's executed in the past. It's very competent and professional. And the project's gone through the hard yards, and we're coming in sort of almost at the end, where we get the good upside in a 50 million market cap, with this thing potentially generating a couple 100 million, using a lot of debt products potentially from off-takers to get the project financed. It's a really interesting position to come in on now.
Yeah, thanks, Sean. No, it's been a pleasure to speak with you, and I look forward to further discussion.
Thank you.